Welcome back to the Profitable Mindset Podcast. Today we're tackling asset allocation. It's about building a financial fortress, one that can weather any storm.
Absolutely. It's the cornerstone of any solid investment strategy. We're not just chasing trends, it's about crafting a portfolio that aligns with your goals, risk tolerance, and time horizon.
Like building a house, we need a solid foundation. We wouldn't build a skyscraper on sand. Let's break down asset allocation and why it matters so much.
Asset allocation is the art and science of dividing your investments. You spread them across different asset classes. Stocks, bonds, real estate, commodities, even alternative investments.
Okay, got it.
Each asset class has its own characteristics, its own risk and return profile. It's like mixing ingredients. The way you mix them determines the flavor of your portfolio.
I like that, the flavor of our portfolio. So it's not just about picking assets, but getting those proportions right.
Absolutely. It's about finding that sweet spot between risk and reward, a mix that helps you achieve your financial goals while staying true to your comfort level with risk. You mentioned in your notes aiming to buy a house in 5 years. That's a medium-term goal. It needs a different approach than someone investing for retirement decades down the road.
Makes sense. My 5-year plan needs a different flavor profile. Someone planning for retiring 30 years out is different. How do we find the right recipe for our unique situation?
Before we start mixing ingredients, we need to understand the building blocks, the different asset classes, how they behave. Let's start with stocks and bonds, the workhorses of most portfolios.
Okay, stocks have growth potential, but they can also be quite volatile. Bonds are generally seen as more stable, but might not offer the same upside. Is that fair?
It's a great starting point. Stocks or equities represent ownership in companies. They offer the potential for high returns, fueled by company growth and profits. But they also come with higher risk. Their prices fluctuate significantly based on market sentiment, economic conditions, and company-specific news.
That volatility can be a roller coaster ride. Bonds, on the other hand, they are like the steady eddy of the investment world.
Exactly. Bonds are essentially loans. You make them to governments or corporations. They offer regular interest payments. It's a steady stream of income. And they typically fluctuate less in price than stocks. But the trade-off, their return potential is generally lower.
So it's a classic trade-off. Higher potential return with stocks, but also higher risk versus stability in income with bonds, but maybe less growth.
That's the key principle to understand. It's all about finding the right balance. For your specific situation, you mentioned in your notes you're comfortable with some level of risk, but you also want to protect your capital. So a blend of stocks and bonds might be a good starting point.
Okay, a blend makes sense, but how do we decide what that blend should look like? 60% stocks, 40% bonds, or something more adventurous like 80% stocks, 20% bonds?
That's where your goals, time horizon, and risk tolerance come into play. Remember that house in 5 years. That's a medium-term goal. It might require a more balanced approach. You can't afford to lose a big chunk of your capital right before you need it. So a portfolio heavily tilted towards stocks might be too risky. On the other hand, if you were saving for retirement decades from now, you could afford to take on more risk to chase those higher potential returns.
So the further out our goal, the more risk we can afford to take. That seems counterintuitive. But it makes sense. We have more time to recover from any potential losses.
Exactly. Time is powerful in investing. It allows you to ride out those market ups and downs, benefit from the long-term growth potential of the market.
So we've got stocks and bonds as the core. What other asset classes should we be thinking about?
Let's talk about real estate. It's a tangible asset. It can provide both growth and income. You can invest directly in properties, or you can explore options like REITs, real estate investment trusts. It allowed you to invest in a diversified portfolio of properties without the hassle of being a landlord.
REITs sound interesting. They offer liquidity, which is something I value.
They do. They can be a good addition to a portfolio. For diversification, real estate often behaves differently from stocks and bonds.
Okay, so we've got stocks, bonds, and real estate. What else should be on our asset allocation radar?
Commodities. These are raw materials like gold, oil, or agricultural products. They can act as inflation hedges, often move independently of stocks and bonds, adding another layer of diversification to a portfolio. You mentioned in your research concerned about inflation eroding your purchasing power. Well, commodities can be a good way to combat that.
That's great to know. So we've got a good spread of asset classes to choose from. But before we get into allocating percentages, I think we need to talk about the elephant in the room, risk.
You're absolutely right. Understanding risk is essential for making smart asset allocation decisions. But risk isn't necessarily a bad word. in the investment world. In fact, it's the engine of potential reward. No risk, no reward, right?
I've heard that saying before. But it's easier said than done when your hard-earned money is on the line. How do we wrap our heads around risk? Make it work for us, not against us.
It starts with recognizing that risk isn't a monolithic concept. There are different types of risk, and each asset class carries its own unique risk profile.
Okay, so it's not just about being risk-averse or risk-loving. It's about understanding the different flavors of risk and how they might impact our portfolio.
Exactly. For example, there's market risk. It's the overall risk of the stock market declining. Then there's specific risk. It's the risk associated with a particular company or industry. You might have a fantastic company, but if their industry takes a hit, their stock price could suffer.
That makes sense. And then there are things like inflation risk, interest rate risk, and currency risk, factors that can impact our investments in different ways.
You're getting it. And we can't forget about liquidity risk. It's the risk that you might not be able to sell an investment quickly or at a fair price when you need to.
Whoa, that's a lot to consider. It sounds like risk is lurking around every corner. How do we measure all these different risks and make sure they don't derail our investment strategy?
We have some powerful tools at our disposal. One of the most widely used is standard deviation. It tells us how much an investment's returns might swing up or down over time. Think of it as a measure of the bumpiness of the ride.
Okay, so a high standard deviation means a wilder ride,
Yeah.
and a low standard deviation means a smoother ride.
Precisely. And this ties back to our discussion about emerging markets. They offer exciting growth potential, but they also tend to have higher standard deviations compared to developed markets. This means their returns can be more volatile, both on the upside and the downside.
That's valuable information. It helps me understand why emerging markets, while attractive, might require a more cautious approach, especially given my 5-year goal of buying a house.
Exactly. And another important measure is beta. It tells us how much an investment moves in relation to the overall market. A beta of 1 means it moves in sync with the market. A beta higher than 1, it's more volatile. And a beta lower than 1 means it's less volatile.
So if the market goes up 10%, a stock with a beta of 1.5 would likely go up 15%, while a stock with a beta of 0.5 would likely go up only 5%.
That's a great way to understand it. And this information can be incredibly useful when constructing a portfolio. Let's say you're concerned about a potential market downturn. You could strategically choose investments with lower betas to help cushion the blow.
Okay, so we've got standard deviation to measure the bumpiness of investment and beta to measure its sensitivity to the market. Armed with these tools, we can start to build a portfolio that aligns with our risk tolerance. But what about the other side of the coin? Return. How do we measure and evaluate the potential rewards of our investments?
Return is what we get for taking on those risks. It can come in different forms. Capital gains, it's the profit you make when you sell an investment for more than you paid for it, and income returns, like dividends from stocks or interest payments from bonds. And just like risk, returns can vary greatly depending on the asset class and the specific investment.
So while stocks might offer the potential for higher returns, they also come with the risk of losing value. Bonds, on the other hand, might offer lower but more predictable returns. It's that trade-off again.
You've got it. And that's why diversification is so crucial. By spreading our investments across different asset classes, those that behave differently, we can potentially smooth out those returns, reduce the risk of having all our eggs in one basket.
Diversification. That's the age-old wisdom of not putting all your eggs in one basket. But how do we diversify effectively? It's not just about randomly picking a bunch of different investments, right?
You're right. There's a method to the madness. Effective diversification is about strategically combining assets, those that have low or negative correlation.
Okay, correlation. That's a term I've heard thrown around, but I'm not sure I fully grasp it. Can you break it down for us?
Think of correlation as a way of measuring how two investments dance together. Do they move in sync, or do they have their own rhythm?
Okay, so if two investments have a high positive correlation, they move in the same direction.
Exactly. If one goes up, the other tends to go up as well, and vice versa. Now, if two investments have a low or negative correlation, they tend to move independently of each other. One might go up while the other goes down, or they might both go up, but at different rates.
So the key to diversification is to find investments that don't all move in the same direction.
Precisely. By combining assets with low or negative correlation, we can potentially reduce the overall volatility of our portfolio without sacrificing returns.
I'm starting to see how all these pieces fit together. But how do we know which assets have low or negative correlation? Do we need to be expert statisticians?
Luckily, there are tons of resources available. They provide correlation data. You can find it on financial websites and investment research reports, and even in some investment software platforms. And remember, correlation can change over time. So it's important to review and rebalance your portfolio periodically to make sure it's still well diversified.
Okay, so we've laid the foundation. With diversification, understanding how to spread our investments across different assets that behave differently. Now, let's explore how our time horizon plays a crucial role in shaping our asset allocation strategy.
Time horizon is a powerful tool. It dictates how much risk we can afford to take on. For long-term goals, like retirement, we have the luxury of time to ride out market fluctuations and let the power of compounding work its magic. But for shorter-term goals, like buying a house or funding a child's education, we need a more conservative approach to protect our capital.
So a longer time horizon allows us to be more aggressive, tilting our portfolio towards growth-oriented assets like stocks. But as our time horizon shrinks, we need to shift towards a more conservative approach, emphasizing stability and capital preservation.
Exactly. Think of it as adjusting the sails on your ship. When you have a long voyage ahead, you can hoist those sails high and catch the full force of the wind, even if it gets a little bumpy along the way. But as you approach your destination, you need to reef those sails in to ensure a smooth and safe landing.
That's a great analogy. It helps me visualize how our time horizon should guide our asset allocation decisions. But before we dive into specific strategies, I think we need to talk about the human element, our own psychology, how it can impact our investment decisions.
You're right. We can draw up the perfect asset allocation plan on paper, but our own emotions can sabotage our best intentions. Fear and greed, those are the two big culprits that can lead us astray. When markets are crashing and everyone is panicking, it's tempting to sell everything and hide our money under the mattress.
I've definitely felt that urge before. It's like our primal instincts
Yeah,
telling us to run for cover.
exactly. And on the flip side, when markets are booming and everyone is getting rich, it's easy to get caught up in the frenzy, chase after the hottest stocks, even if they're ridiculously overvalued.
Oh, the allure of quick riches. It's hard to resist sometimes.
It is. But that's why it's so crucial to have a solid asset allocation plan in place, a plan that's rooted in logic, not emotion. And it's equally important to understand our own behavioral biases, develop strategies to mitigate them.
Okay, so we need to be aware of our own emotional triggers. Have a plan in place to prevent them from hijacking our investment decisions. But how do we develop that resilient investor mindset? How do we stay calm and rational when the market is throwing a tantrum?
It starts with defining our goals, having a clear understanding of why we're investing in the first place. When you know your why, those short-term market fluctuations become less scary. You're able to zoom out and focus on the long-term picture.
So it's about having a long-term vision and not getting distracted by the daily noise of the market.
Exactly. And it's also about recognizing that markets are cyclical. They go up, they go down, and they go up again. It's the nature of the beast, trying to time the market perfectly. It's a fool's errand.
So instead of trying to predict the unpredictable, we should focus on building a diversified portfolio that can weather those inevitable storms.
That's the key. And remember, you're not alone in this journey. There are resources, tools, even professional advisors who can help you navigate the complexities of asset allocation. Build a portfolio that aligns with your goals and your risk tolerance.
That's reassuring to hear. Okay, we've covered a lot of ground in this first part of our discussion on asset allocation. From the different asset classes and how they behave, to the importance of understanding risk, correlation, and time horizon. We've also touched on the psychological aspects of investing and the need to develop a resilient investor mindset. But how do we put all these pieces together? How do we actually go about building a portfolio that can help us achieve our financial goals?
That's exactly what we'll be diving into in the next part of our discussion. We'll explore different asset allocation strategies, from the classic 60-40 portfolio to more sophisticated approaches, like risk parity and factor investing. We'll also look at how to tailor our strategy to our individual goals, risk tolerance, and time horizon.
Sounds like we've got a lot more to unpack. I'm eager to dive in and learn more.
Welcome back to the Profitable Mindset Podcast.
All right, let's get to the exciting part. Building our asset allocation strategy. It's like we gather the ingredients. Now it's time to create the perfect recipe for financial success.
Exactly. And remember, there's no one-size-fits-all. The best strategy depends on your goals, your risk appetite, and how much time you have to reach those goals.
So let's start with the basics. What are some of the core strategies that we can consider?
One popular and time-tested approach, The classic 60/40 portfolio. It's a simple strategy, but powerful. Served investors well for decades.
Ah, the 60/40, 60% stocks for growth, 40% bonds for stability. I've read about it. How does it actually work?
It's about balance, risk, and reward. Stocks offer potential for higher returns over the long term, but they come with higher volatility. Bonds provide stability and income, typically lower growth potential, by combining the two. In a 60/40 ratio, you create a portfolio that aims to capture both growth and stability.
Okay, so it's like a balanced meal. Protein and carbs to fuel our financial journey. You mentioned this strategy has worked well for decades. Why is that?
The 60/40 portfolio has historically provided decent returns while managing risk. It's based on the idea that stocks and bonds tend to move in opposite directions, at least to some extent. When stocks are having a bad day, bonds might actually hold their value, or even go up, and vice versa. This negative correlation smooths out the bumps, reduces volatility of the portfolio.
So it's the diversification principle at play again, spreading our risk across assets, assets that behave differently.
Exactly. The 60/40 portfolio is a great illustration of how diversification can work. It's not about eliminating risk, but managing it intelligently.
That makes sense. But is the 60/40 portfolio still relevant today?
It's a great question. The 60/40 portfolio has faced challenges in recent years. Interest rates being so low, bonds haven't provided the same level of return historically. However, it's still a valuable framework. Many investors use it as a starting point, then make adjustments based on their specific circumstances.
So it's not a rigid rule, but a flexible guideline. We can tweak the percentages based on our own risk tolerance and market conditions.
Exactly. For example, if you're younger, have a longer time horizon, you might tilt your portfolio more towards stocks, maybe 70% or even 80%. You have more time to ride out the volatility, capture that long-term growth potential.
And someone nearing retirement, shorter time horizon, might opt for a more conservative approach, maybe 50% stocks and 50% bonds, or even less exposure to stocks.
That's right. It's all about finding the right balance for your individual situation. But remember, even within the 60/40 framework, we can further diversify by investing in different types of stocks and bonds.
Okay, so we can choose from a variety of stocks: large cap, small cap, value stocks, growth stocks, international stocks. And for bonds, we have options: government bonds, corporate bonds, even high-yield bonds.
You've got it. By spreading our investments within these categories, we can further reduce risk, enhance potential returns. For example, you mentioned you're interested in socially responsible investing. Well, there are ESG, environmental, social, and governance-focused funds, allow you to align your investments with your values.
That's fantastic. I can build a portfolio that aims to grow wealth, but also make a positive impact. Okay, so we've got a solid foundation, the 60/40 portfolio. We can tweak it based on our individual circumstances. What other strategies should we have on our radar?
Let's step outside the traditional 60/40 box, explore some more advanced strategies. One approach that's gained traction is risk parity.
Risk parity. That sounds intriguing. What sets it apart from the 60/40 approach?
Risk parity shifts the focus from traditional weighting of assets to the weighting of risk. It's based on the idea that we should allocate capital based on how much risk each asset class contributes to the overall portfolio, rather than allocating based on percentages.
Okay, so instead of just dividing our money evenly, like 60% stocks and 40% bonds, we're looking at how much risk each of those asset classes brings to the table.
Exactly. A $10,000 investment in a high-growth tech stock with its potential for swings might bring more risk than a $10,000 investment in a government bond. Risk parity balances out those risk contributions, creates a portfolio that's more resilient to market shocks.
That sounds like a smart approach, especially in today's uncertain world. But how do we actually build a risk parity portfolio? It sounds complex.
It can get a bit technical, but the core idea: adjust the weightings of different asset classes. Ensure each contributes roughly the same amount of risk to the overall portfolio. So if stocks are more volatile than bonds, you might need a larger portion of your portfolio in bonds to balance things out. And sometimes, to maintain a certain level of return, risk parity investors will use leverage carefully, amplifying the impact of their lower risk assets.
Okay, so it's about strategically using leverage
Well,
to boost the potential return of those less volatile assets. It sounds like a sophisticated strategy. Requires careful planning and expertise.
it does, but the potential benefits are compelling. Risk parity portfolios have historically shown lower volatility and smaller drawdowns during market crashes compared to traditional portfolios.
That's impressive. It sounds like a good option. For investors who are looking for smoother returns, and are comfortable with complexity. What other advanced strategies are out there?
Another approach that's gaining popularity, factor investing. Remember those factors we talked about earlier: value, momentum, quality, and size. Factor investing is about tilting your portfolio toward those specific factors that have historically outperformed the market.
Okay, so it's not just about picking stocks or bonds, but looking for those underlying characteristics that drive returns.
Exactly. For example, you mentioned that one of your sources highlighted the outperformance of value stocks
Hmm.
over the long term. Well, you could build a portfolio that targets value stocks or uses factor-based ETFs that track a value index.
So I can align my portfolio with those factors that I believe will drive returns in the future.
That's the idea. And you can even use a technique called factor rotation. Adjust your portfolio based on which factors you think will perform best in the current market environment. For example, if you believe inflation is going to rise, you might shift more of your portfolio toward factors like value and momentum. They've historically performed well during inflationary periods.
Okay, so we're adding another layer of strategy. By being selective about the factors we expose our portfolio to.
Right. It's about being strategic and thoughtful, not just blindly following the crowd. We can even combine factor investing with other approaches, like risk parity. Create a truly customized portfolio.
So many options. It's amazing. We can fine-tune our asset allocation strategy to match our goals and beliefs. But with all this talk about stocks, bonds, and factors, are we forgetting about the rest of the world?
That's a great point. It's essential to look beyond our borders. Consider global asset allocation.
So we're talking about adding international investments to the mix.
Exactly. Global diversification can not only reduce risk, but unlock new growth opportunities.
Okay, I'm listening. What are the main benefits of going global?
Well, first, risk reduction. Remember correlation. Different countries and regions often have different economic cycles, different market dynamics. By diversifying across global markets, we can reduce volatility of our portfolio. Think of it as spreading our bets across multiple roulette wheels.
Okay, so it's like we're not putting all our eggs in one geographical basket. What other benefits?
Global diversification gives us access to a wider range of investment opportunities. Different countries specialize in different industries. For example, Germany, engineering, Japan, technology. By investing internationally, we tap into unique growth stories.
That makes sense. I've heard emerging markets, while risky, offer exciting growth potential.
You're right. Emerging markets like China, India, and Brazil, they are experiencing rapid economic growth. Their stock markets often outperform those of developed countries, but they come with higher risk due to political instability, currency fluctuations, less developed regulatory environments.
So it's about finding the right balance. The higher growth potential of emerging markets and the stability of developed markets.
Precisely. And we can further mitigate risk by diversifying across different regions within emerging markets. Don't put all your eggs in one emerging market basket.
Got it. So we can build a global portfolio, mix of developed markets, emerging markets, and even frontier markets, which are the riskiest, but potentially the most rewarding. But what about those currency fluctuations? Don't they eat into our returns?
That's a valid concern. When you invest in foreign markets, your returns are impacted by changes in exchange rates. If the currency weakens against your home currency, your returns will be lower.
So how do we protect ourselves from those currency swings?
There are a few strategies. We can hedge our currency exposure using financial instruments, like currency forwards or options. Or we can choose to invest in funds that automatically hedge their currency risk.
Okay, so we've got options to manage that currency risk.
Yeah.
But it sounds like global investing adds another layer of complexity to our asset allocation strategy.
It does, but the potential benefits are compelling. Global diversification can help us reduce risk, access new growth opportunities, and even provide a hedge against inflation. And with global ETFs and mutual funds available today, it's easier than ever to build a globally diversified portfolio.
That's reassuring. Okay, we've explored a range of asset allocation strategies, from the classic 60-40 portfolio to more sophisticated approaches: risk parity, factor investing, and global diversification. It's amazing how much customization is possible. But before we move on, I think it's important to talk about real-world examples. How have these strategies played out in practice?
That's a great point. Let's look at some case studies of successful asset allocation strategies. Illustrate how these principles can be applied in real life.
Perfect. I love learning from real-world examples.
One of the most well-known approaches, Ray Dalio's all-weather portfolio. Dalio, the founder of Bridgewater Associates, one of the largest hedge funds. Design this portfolio to withstand any economic storm.
I've heard of that. It's supposed to perform well
Yeah,
in any market condition, right?
exactly. Dalio's philosophy. You can't predict the future. You need to be prepared for anything. The all-weather portfolio allocates across a mix. Stocks, bonds, gold, and commodities. Each plays a specific role in managing risk and generating returns.
So it's like a diversified portfolio on steroids.
You could say that. It's designed to perform well, whether the economy is booming, in a recession, experiencing high inflation, or even deflation.
Sound like a pretty robust strategy. How does it actually break down in terms of asset allocation?
The classic all-weather portfolio allocates roughly 30% to stocks, 40% to long-term bonds, 15% to intermediate-term bonds, 7.5% to gold, and 7.5% to commodities.
Okay, so it tilts more heavily towards bonds, includes significant allocations to gold and commodities as inflation hedges.
Exactly. This allocation, designed to provide a balance between growth and stability, strong emphasis on risk management.
It sounds like a great option for investors who are looking for a sleep well at night portfolio, even during turbulent times. What other case studies are there?
Let's look at a very different example. The Yale University Endowment Fund.
Yale. Aren't they known for academics,
Yeah.
not investments?
You might be surprised to learn that they're pioneers in the investment world. Under the leadership of David Swensen, their legendary chief investment officer, the Yale Endowment adopted a highly successful strategy, emphasizes alternative investments.
So instead of sticking with stocks and bonds, they've entered into less traditional assets.
Right. They allocated heavily to private equity, real estate, hedge funds, even natural resources. Their long-term focus and willingness to embrace alternative assets yielded exceptional returns over the decades.
I'm sensing a theme here. Diversification is key. But for those of us who aren't running billion-dollar endowments, what are some more accessible strategies?
Well, the classic 60-40 portfolio is still a popular choice, especially for retirement investors.
The 60-40. 60% stocks, 40% bonds. Why is this strategy so enduring?
Because it's simple, effective, provides a balance between growth and stability. Stocks fuel long-term growth. Bonds provide a cushion. During market downturns, it's a time-tested approach, worked well for many investors.
That's reassuring. But what about those who are a bit more adventurous?
Tactical asset allocation. We discussed it earlier. Good option for those who want to actively manage their portfolios, make adjustments based on market conditions. In recent years, we've seen a surge in interest in cryptocurrencies.
Crypto, that's the Wild West of investing.
It can be volatile, but it's also generated incredible returns. For some investors, many are adding a small allocation of Bitcoin or Ethereum to their portfolios, seeing it as a way to diversify, potentially boost returns.
It sounds like there are so many ways
Yeah.
to approach asset allocation.
Right. The best approach depends on your goals, your risk tolerance, your time horizon, and your comfort level with different asset classes. It's about finding the strategy that fits your unique financial personality.
Okay. I'm starting to feel like an asset allocation pro. But before we wrap things up, can you share any final tips or takeaways for our listeners?
Sure. Asset allocation is the foundation of a successful investment strategy. Diversification is crucial. Don't put all your eggs in one basket. Your time horizon and risk tolerance are your guiding stars. There are strategies for every type of investor.
Okay.
It's about building a portfolio, one that aligns with your financial goals. Stay informed, stay disciplined, and stay focused on the long term.
Great advice. We've covered a ton of ground today. What a fascinating exploration of the art and science of asset allocation. We've covered a lot of ground, exploring everything from stocks and bonds to strategies like risk parity and global diversification. But some listeners might be thinking, this is all great, but what about those unexpected market crashes? The black swan events, the ones that seem to come out of nowhere. How do I protect myself from those?
That's a great question. It's important to be prepared. Even with the best asset allocation strategy, we need to be ready for unexpected market storms. That's where tail risk hedging comes into play.
Tail risk hedging, huh? Sounds a bit like an insurance policy for our portfolio.
You got it. It's about protection. From rare, extreme events that can really shake up the markets, think of it as a financial bunker for those worst-case scenarios.
So how do we build that bunker? What tools can we use for tail risk hedging?
One approach, allocate a portion of your portfolio to safe haven assets. These investments tend to hold their value, or even go up during market turmoil.
Okay, I see. So like emergency supplies, ready for when the storm hits. What are some examples of safe haven assets?
Well, gold is a classic one. Historically, it's held its value during uncertain times, economic uncertainty, geopolitical turmoil.
Gold, huh? The shiny object. A store of value for centuries.
And then there's the US dollar, the world's reserve currency. The dollar tends to strengthen during times of global risk aversion. So, holding US Treasury bonds, they can provide a degree of safety.
Okay, gold and U.S. Treasury bonds. Makes sense. The go-to options for a reason.
Yeah.
Any other safe haven assets we should consider?
Well, you could look at the Swiss franc, often considered a safe haven. Because of Switzerland's neutrality, strong financial system, and certain defensive stocks too, companies that provide essentials, like utilities, healthcare, they tend to do better during economic downturns.
So diversifying within our safe haven assets too, not putting all our eggs in one basket.
Exactly. And another approach to tail risk hedging, using financial instruments like put options.
Put options, those sound a bit complex.
They can be, but they can also be effective. A put option gives you the right, but not the obligation, to sell an asset at a specific price by a certain date.
Oh, I see. So it's like locking in a minimum price, protecting from big losses if the market drops sharply.
Right, like buying insurance for your portfolio. But put options come with a cost, like any insurance policy.
So paying a premium for that downside protection.
That's right. And the cost can vary. Depends on the asset, the price, the time until it expires.
It sounds strategic, needs careful analysis.
It does. But for investors worried about tail risks, put options can be valuable to their hedging strategy.
Okay, so we've got safe haven assets, we've got put options as our tail risk hedging tools. How much of our portfolio should we use for these strategies?
That's a question each investor needs to answer, based on their own risk tolerance, their assessment of the chances of tail events. Some might allocate 5% to tail risk hedging, others might go up to 20%, even more.
So finding the balance between protection and potential return.
Right, because remember, tail risk hedging can impact returns in a bull market, like paying for insurance you might not need.
But when those unexpected events do happen, that insurance can be really important.
Absolutely. It can help preserve your capital. Avoid those really big losses, the ones that can derail your long-term goals.
Okay, so we've covered a lot today on asset allocation, from the different asset classes, the principles of diversification, understanding risk and return, even the psychology of investing. We explored strategies, the 60-40 portfolio, and more advanced approaches, risk parity, factor investing, global diversification, and even tail risk hedging.
Ooh, yeah, it's been quite a journey. Asset allocation isn't just a one-time thing. It's a process.
Right. It's about reviewing our portfolio, making adjustments as we need to, based on goals, risk tolerance, and market conditions.
Exactly. Stay informed, stay curious, and keep learning. Investing is always changing. Staying ahead of the curve is essential.
Great advice. I think we've given our listeners the tools for building a profitable mindset, a portfolio that can help achieve their financial dreams.
Absolutely. The most important investment, invest in yourself, in your financial education.
Well said. Thank you for sharing your wisdom and insights with us today.
It's been a pleasure. And to our listeners, stay focused, stay disciplined, keep building that profitable mindset.
And that's a wrap for this episode of the Profitable Mindset Podcast. We'll see you next time.